I know a lot of people in the audience and some people on our staff very worried about what's going on in the housing market and what it's gonna look like over the next year or two. It doesn't seem like what's been going on can be sustainable. And it turns out that the vibe here at TYT is reflected across the country because apparently searches for the phrase, when is the housing market going to crash, are up 2,450% just over the past month. Similarly, Americans are searching in droves for explanations about why the housing market is so hot and why home prices are rising. So look, we have talked about this multiple times, and I have some responses to the current state of the housing market from some insiders, as well as some explanations about how we got here. But I wanted to make sure that we have time for both of you to weigh in, especially Nomi. Is this something that you're particularly worried about, or are people, like the rise in Google traffic like that, is that freaking out a bit disproportionately?
Well, here's the reason it is worrying that the housing market, and by that I mean the homes that are going up by 40 or 50% over where they would have been last year, because people are buying them with cash, and not, under sort of, in some cases, not even looking at them. And it's not just actual people. One of the elements that's making this housing market so out of whack is the fact, and this happens, is that there's some bottom fishing going on even at high prices from things like private equity funds and like real estate sort of programs or groups of investors. And they have the ability to put cash into a real estate deal as soon as they see a home, whether they're physically seeing it or not, as soon as it comes on the market. And as a result, real actual people, even if they wanted to follow the other part of the trend that's moving prices up, which is sort of leaving from urban to more suburban or outside of city locations, because some people can work from home because it seems more desirable, because COVID and the pandemic made city living much less healthful, and it was already expensive to begin with and so forth. A lot of those people, like actual real people who don't have tons of cash or aren't a private equity fund, aren't able to actually do that. And so they're getting sort of priced out of this market, which is why I think the second part of that search was, why is the housing market so hot? Now, the other side of that is will it crash, right? And one of the things that happens, this is a housing bubble. It's a different kind of a bubble than the subprime mortgage market initiated back in the day that related to the financial crisis, because investment banks are doing something a little bit different. Then they were buying up subprime loans, which were given at very high interest rates to lots of people. Then the economy turned, they couldn't pay those rates, or those rates went up relative to what they thought they would be able to pay. They couldn't pay the extra, and a lot of foreclosures and defaults happened because of that. So investment banks got smart, and they're actually not lending, even though rates are so low again, to most people who might want to buy a home right now for the reasons of leaving the city and going outside of it. And so those people aren't actually in the market, nor can they afford the market because they don't have the money. But the leverage that's coming into the system, the money that the borrowing, and where the borrowing is happening, is in some of these funds, because they get money really cheaply from some of the big banks. They have these sorts of lines. They're able to go in and purchase properties. And oftentimes when you hear so many stories around the country of 20 bidders, 40 bidders, basically offering 100% or 140% cash over asking price, not all of them are actual humans, or they're not individuals. And so it is creating a skew for the affordability of housing, as well as a problem, because people who make normal money or lost money this year, lost jobs this year, and want to potentially move or buy a house, are finding that they can't actually get loans, even though these prices are so, these rates are so low right now because of where the Federal Reserve is at. So there are problems brewing behind this bubble that can cause a housing crash. They're merely different in terms of how they're evolving than they were last time around.
So Nomi, to me, the most important question is, yes, this was a trigger last time, and it's an important question to ask whether it's going to be a trigger for a crash this time. But the gun was the derivatives. That was the gambling that they did on top of the housing market, and so they would do $10 or oftentimes more of bets on top of a $1 value of the homes or the package of homes, to oversimplify, right? Or 10x of the value.
Right.
So are they doing that again this time or no?
There is an element of the market in which that's being done. So a lot of these either private equity funds or real estate pools, some of these actually are borrowing lots of money relative to the house or relative to other collateral they might have in order to be able to be really quick with these, above offer type of cash. Offers to these homes, which is what's bidding them up. And so not the entire market. In the case of the financial crisis, you're right. The market crashed because banks basically used every single individual subprime loan to line lots of different derivative products and so forth. The derivative products right now are still related to real estate, but they're a little bit different. They're leverage or they're additional borrowing, sometimes in the form of derivatives related to real estate groups or pools that aren't necessarily subprime loan related, but they are related to still creating excess borrowing over to not individuals, but to sort of groups and to funds and to firms that are pooling together to be involved in the real estate market and bidding up prices as a result. So yes, there is leverage in the market, and there are some elements of derivatives or different sorts of engineering around that, as well as real individuals who are putting down cash because they're on the we need to leave the urban and go to suburban side of things, and they simply had the cash. So there's two different areas from which money is coming. The leveraged part of it is the part that's most likely going to cause a housing crash.
Yeah, that's what I'm really worried about is the leverage, because that's basically the gambling part. So. But I want to ask also about their excuse. They're saying, no, this is not a problem. We don't have a bubble, even though the prices are overinflated by about 15% or so, roughly speaking. And some markets are way higher than that in terms of overinflation. But they're saying it's actually natural because of the pandemic. People are looking to move out to the suburbs or wherever, or rural areas, and buy houses. And there's definitely some truth to that. But what percentage of that is what's actually causing the problem versus the other factors?
Right, and I think the majority of the factors that the people that do want to move out often, and the percentage of second home buying is actually quite high, because what's happening is, in general, there's not enough supply in the market. In other words, people aren't selling the homes that they're living in the more desirable areas, so outside of the city areas, because they can't afford to buy anything else. And they're like, hey, we're in and outside of the city area anyway. Why would we move, and where and how could we move there, right? So there's a lot of staying put, and that is creating one of the elements of this, which is there's more demand for outside of city places than supply. And that's why on average, even though prices might be looking like they're up 15% nationally, they're up 40, 50, 60 or more percent on an individual house in a lot of specific areas. And that's what's creating these sort of like pocket bubbles throughout all of these areas. So that is one of the causes. But a lot of the people that are doing that are also on second home buying because they can afford it, because banks aren't actually loaning as much to some of these buyers as they did back even before the financial crisis, or at some point since the financial crisis. It's not coming out of lending as much as it's coming out of people's cash, or again, these pools of money in different forms of private equity or distressed buying or other types of funds that are borrowing on top of it in order to buy up the market on the assumption, and this is similar to the assumption of the pre-financial crisis period, that these housing prices will always go up. And so they're basically kind of cornering the market with leveraged money. It's not real people that are buying up and bidding up the prices on a lot of this. When I say real people, I mean most real people don't have $500,000 to $1 million to more dollars sitting around to throw in an all cash bid, and close it that day. That's not normal for most people's budgets.
Yeah, my last thought on it is this. So guys, if you're not aware of this phenomenon, we talked about it a couple times on the show. Wall Street's buying up houses, a lot of the houses, because after the foreclosures, that they foreclosed on the homes, and then they thought, wow, these are really cheap, and nobody has any money left. So they bought up a lot of those homes, and now they're charging rent back to the people who no longer have the money for a down payment and can't buy the homes. So then they're building up the equity in those homes rather than the individual homeowner, the real people that Nomi's talking about. And so they figure it's a win-win. I'm gonna get the rent, I'm gonna pay for it that way, and I build the equity and I screw over the homeowners in two different ways. But the problem here is that if they're playing that game too aggressively and they're driving up the prices too much, and then they're using leverage to bet on it again, well, then we've rebuilt a bubble that is very dangerous, not just for the housing market, but for the entire economy.
And all those neighborhoods in which the real spikes are happening.
Right. So yeah, so we'll obviously follow the story and see if how it develops. But right now, everybody's got a different view on how much of a red alert it is, and but certainly it's something that we should all be concerned about to some degree and keep a careful eye on, because here we go again. It could easily explode at some point.